Hey, thanks everyone for joining our monthly webinars. As Hassan mentioned, we won't be doing one next month. We'll just be taking a break. But I'm really thankful that we have Carl here every month sharing his tidbits, his strategies that he's learned over the many decades that he's been in business with the ultra high net worth and family office. And today we're talking about how this one strategies help the super wealthy in Canada, like avoid paying taxes. So I'm really interested in hearing what he has to say about this. I've been working with Carl for many years, and he has always been able to give so much insight into how to structure businesses and how to structure taxes. And I'm just so glad that he's offered up his time to be able to add value to me and all of you. So without further ado, Carl, thank you for joining us today.
Great, thank you very much, Gary. So just to have a quick caveat that we start the whole thing off with, I am not necessarily a tax expert. I do know a lot about tax just because of the situations I find myself in a lot of the time. So today what I want to do is really just make you aware of this strategy. I'm not going to go into details as to how it works. I'll give you enough detail where I believe you'll understand the way it works, but in terms of very detailed questions about how to implement it, I probably won't go into that. The one question I think is important for us to think about, again, this is a more advanced tax strategy, and because it's more advanced, generally speaking, this strategy has been used by, as you mentioned, very wealthy families in Canada. Some of us may not be at that place yet where we're a very wealthy family and we're looking at creating a dynasty. So I want to put it back to you guys where you start thinking about how learning about these things, how becoming aware of these things really helps you in your life or might help you in your future as you progress through your business career. So that would be something I'd be really interested in hearing about at the end of the call, just kind of where you came to in terms of why you think something like this might be valuable to at least be aware of. So we have a business that is owned by an individual, which is a sole proprietor. Some businesses may just be that. That's just a single person operating a business. The next stage, maybe you're going to partner with somebody, and at that stage, you've got a partnership. So both these are pretty simple. Generally speaking, sole proprietor, you just own the business directly. When we're looking at a partnership, you own the business directly again, but generally you own that business with a partner. So maybe it's 50-50. So those are the simplest forms of business ownership. We can also own businesses through different entities. The most common entity that we might own a business through would be a corporation. So when we're talking about an estate freeze, we're talking about a corporate tax strategy. And so we're going to be dealing with a corporation that owns that business, right? So that corporation usually has an owner, and that owner is likely to be a person. So say this person owns 100%. So from a very basic point of view, that's what we're talking about. We're not talking about sole proprietor. We're not talking about partnership. We're talking about a corporation and how we can take advantage of that corporation for tax purposes. So we own the corporation. There's going to be an individual that owns the corporation. They have different ways that they can own this corporation. They can own common shares, or they can own preferred shares. So this information will get more relevant as we go along. So as the company, we all expect that company over time is going to grow in value. The common shares take part in that growth. So the common shares, if this company is worth $1 million today and it's worth $10 million later, the common shares were worth $1 million today, and the common shares were worth $10 million later. And the common shares allowed you to vote. They had the control of the company. Okay, so they control the company and they grow with the company. Preferred shares do not grow with the company. So this is all generally speaking. So as the company grows in value, the preferred shares stay the same. So they are not going to grow in value. And generally speaking, they do not control the company. All that usually happens is they might get a dividend. So an annual payout of a certain amount of money for the preferred shares. So the preferred shares, if they were worth $1 million at the beginning, even after all this growth, the company's worth 10 million, the preferred shares are still worth $1 million at the end. Okay. So we're looking at a corporation. We're looking at two different types of shares, common shares and preferred shares. And those are the tools that we're going to use to do this tax strategy. There are many different share types. We're only looking at two right now.
Carl, you want to explain to those who might not know what's the difference between common and preferred shares? So preferred doesn't take part in the asset appreciation of the corporation?
Yeah, so common shares will grow and you have the control over the company. Preferred shares, no growth, no control. So common shares also, they can receive dividends or distributions. So can preferred shares. So really, the primary difference is no growth, no control, growth and control.
So
that's not true 100% of the time, but it's generally true.
So why would someone want preferred if common is clearly better, right?
It might be a case, so this might be, I'm just kind of giving you a scenario, but it might be a case where, say, 3 people start a company. 2 of those people are really gung-ho to build that company as big as possible. So they say, hey, we want to grow as big as possible. We want all of the shareholders to throw in $1 million so that we grow really, really fast. And 2 of them say, yeah, that sounds great. I'll throw in $1 million. I'll throw in $1 million. And the third person's like, well, I don't know whether I really want to throw in $1 million right now. So what might happen is they rejig the company a little bit. So these 2 have the common shares. This person has the preferred shares. So they won't participate in that growth that all this capital has caused, but they still have ownership of the company. And when everybody gets a dividend, they'll get a dividend too. And so it allows for slightly different intentions.
Okay, I see.
In a company, right? And also the one that I'm going to show you today will show you a reason that we would use preferred shares also. But yeah, sometimes you don't need the control or the growth of the company. So we've got we'll call him Jerry up here. And he's got 2 kids, Maya and Bill. So these 2 kids are very involved in Jerry's company. Jerry now turned 65, and he doesn't really want to take on the role of managing his company anymore. Maya and Bill are great for doing that. So Bill wants to give this company to his kids. So say he just does it in the normal way, and say he brings the 2 kids in. And they manage the company. So Bill, here's the company. Bill and Maya are managing it. Bill continues to own it, and he may be, or sorry, Jerry continues to own it. And he might say in his will that that company will go to Bill and Maya in the future. So he's got a promissory note, he's got a contract with them that it's going to go over time. So say this company, it started at $0. And at the time that Bill turned 65, it is now $4 million. And then in another 40 years, when Bill is, well, let's call it 30 years, when Bill's expected to die, it's expected to be $10 million at that point. So Bill dies at 95, which is 30 years later. The company is worth $10 million. And what we call the ACB, the adjusted cost basis of the company, is $0. So he has a $10 million gain, which is $2.5 million that he's got to pay in tax on the value of that company. So a quarter of the value of that company when he dies is going to go to tax. So he wants to try to avoid that as much as possible. That's the problem right there, that $2.5 million. So what he does is at 65 years old, here's Bill. He does something called an estate freeze. So he has all the common shares. What he does is he switches those for preferred shares. So the company at this point is worth $4 million, right? So he's got $4 million of common shares. He switches those, so now he's got $4 million of preferred shares instead. So because he hasn't actually cashed out, there's no tax transaction that happens here. He just switched out one kind of share for another kind of share.
All right.
So now all these common shares, he's going to give those to Bill. Sorry, this is Jerry. I keep getting them mixed up. I should have used a different name. He's going to give those to Bill and Maya. So now Bill and Maya have all the common shares and all the voting shares because they're managing the company. Jerry's got all the preferred shares.
So before, who had in the beginning, Jerry had all the shares, right?
Yeah, to begin with, Jerry had 100% of the
Yeah,
common.
and then so Jerry, he at 65, he converted his shares into preferred.
Preferred, exactly.
And then how did he come up with extra shares to give as common?
He took those original common shares and gave them to Maya and Bill.
Like, you mean he created new shares?
No, the existing shares he gave them to Maya and Bill.
I thought you said he took the existing shares and changed it to preferred. Like, did he have extra shares? Like he had 1,000 shares, he took 900 and turned them to preferred, and 100.
Oh, so sorry. The way that he actually does it is he issues the shares out of the corporation. Yeah, so he issues new shares.
Oh, he issues
They're worth
new
zero.
shares. So he took his $4 million of common shares, converted into preferred, and then he issues another $4 million of common shares and gives those to Bill and Maya.
Those new shares are going to have a value of zero.
Oh, okay.
Because this value is now in the preferred shares.
Okay, so he issues new shares that are worth nothing,
Yeah.
and those new common shares he gives to Bill and Maya.
Yeah.
How many does he issue? Just doesn't matter, or
He issues, it doesn't matter, 100 shares.
okay, doesn't
100
matter.
is a normal amount, right?
So the point is he issues new shares valued at zero and gives it to his children.
Yeah.
Okay.
So now the interesting thing is we're still going to continue to appreciate in the company, right? It's going to go from 4 million to 10 million. Now Jerry dies at 65 when the company is worth, or sorry, 95 when the company is worth 10 million. And when he dies, there is only the $4 million of preferred shares that need to be taxed. So now he's only going to have to pay $1 million, or his estate is only going to have to pay $1 million in tax instead of the $2.5 million that they had to pay before. So he decreased his tax rate from 25% to 10%. All that future growth, that $6 million, that is attributed to Bill and Maya. And they don't have to pay the tax on it right now because they didn't die. They still own the shares.
So their shares were worth zero when they got it when Jerry was 65, but when Jerry was 95 and Jerry died, Bill and Maya's shares went from zero to $6 million.
Exactly. So the future growth of the company was captured by Bill and Maya, not by Jerry. So that's step one. So is everybody on board here? Everybody understand what's going on, how this works? So an interesting thing about a lot of these strategies, a lot of these basic tax strategies, and though this might look simple, as we saw with we're talking about how the shares were allocated here, and it's quite complex when you actually implement something like this. So you probably need to deal with a fairly sophisticated tax accountant if you were to do something like this. But on its face, it's fairly simple when you kind of just look at the basics as we've done today. But a lot of these basic tax strategies, we can take them and we can maximize them so we can get an even greater benefit from them. So a lot of the time, what we do is we combine concepts so that we can reduce the tax even further. So this one is called an estate freeze, as we've kind of already talked about. What I'm going to talk about now is still an estate freeze, still takes the basic foundation of an estate freeze, but takes it one step further. And it's called a wasting freeze. So now we look at that same situation. So we've got the corporation. And now we've already done the estate freeze. So we can check that box. Now we're ready to do our wasting freeze. So we're going to look specifically at Jerry. And I got to remember that he's the dad in this case. So Jerry owned the company. And as we will all recall, he's now got $4 million of preferred shares, right? So that means the kids are going to be operating the company going forward. Jerry's not going to vote. Jerry's not going to take any participation in the growth of the company from here on in. But Jerry still needs to live. So Jerry still needs to draw some money from the company. Jerry, in our example here, still has 30 years of life ahead of him. And we know that Jerry has pref shares, and you can get a distribution with a pref share. You can get a dividend, you can get some kind of annual payout with a pref share. So what Jerry is going to do is he's going to ask his kids if he can get $100,000 a year. So he wants $100,000 coming out of the corporation. So say Jerry took that straight as a dividend. Over the next 30 years, he will have pulled out $3 million, and he will have paid his regular tax on that, right? Whatever his personal tax is on that. And as we saw before, he's still got that $4 million gain. So he's got to pay the $1 million tax, right? So $4 million gain, which equals $1 million tax. So ideally, Jerry doesn't want to pay that $1 million if he can help it, right? So what can Jerry do? Right now, he's taking a dividend worth $100,000 a year. Jerry says, well, instead of taking that dividend, why don't I sell $100,000 of my pref shares every year and take that? So now he's still going to get that $100,000 a year, but now he's going to get it through a sale of pref shares. So again, over 30 years, he's going to pull out that $3 million. And just as over here, he still has to pay his personal tax on that. But when he dies now, he had $4 million of pref shares. He's redeemed $3 million of pref shares. So he's only got $1 million of pref shares left, right? And at his tax rate, that is going to be $250,000 of tax. So he reduced his tax from $2.5 million to $250,000 by using an estate freeze first, and then when the estate freeze was in place, doing a wasting freeze. So that is, so Of course, in insurance, we always have our specific strategies that we use for estate planning. Insurance people don't usually think about this strategy much because it's not kind of our expertise. It's not really our wheelhouse. But whenever an accountant thinks about how you're going to manage an estate for somebody, how you're going to deal with these wealthier families, an accountant is always going to go, well, maybe I shouldn't say always, but the standard practice of an accountant is that they're going to go here first.
So accountants are familiar with these estate freeze and wasting freeze strategies?
Yeah, very much so. It's their go-to for any kind of tax planning for an estate. This is their go-to. But again, all accountants will be aware of this. It takes a certain amount of expertise to implement one of these. So it's not going to be implemented by any old accountant. It's going to have be somebody with a certain specialization in estate planning.
So this is like, doesn't matter if it's a public or private corporation. If it's a public, he sells his preferred shares on the stock market. If it's a private, he just sells it to a relative or something like that.
I'm going to say the only kind of businesses I've ever dealt with this strategy are private corporations.
Oh, okay.
So I wouldn't want to comment on whether it would be made useful for a public corporation or not. But there's a certain kind of corporation in Canada, which is a Canadian controlled private corporation. It's generally called a CCPC. This is a strategy that is generally used for a CCPC. One of the primary reasons is a CCPC often has 2 generations of people who are going to own the company within the same family. So this is, generally speaking, this is a corporate and family tax planning tool. So it is generally used by wealthy families rather than kind of individuals or a group of unrelated individuals like shareholders in a public corporation. But
So if it's a private company, who do they sell those preferred shares to?
oh, they redeem it back to the company.
Oh, sell it back to the corporation.
Yeah, so the company just retires those shares as they come in.
And then just withdraw the money from the corporation.
Exactly. So that's a very good question. I think it clears up exactly what happens there. All of those pref shares are being bought by the company or redeemed by the company. And the whole thing on the wasting side is just instead of paying whatever you pay, salary, dividends, instead of doing that, you are doing redemptions of shares. And those redemptions end up being a deemed dividend. So for tax purposes, it's treated like a personal dividend, just as it would be on this side.
So Carl, Anne has a question. In the event of liquidation of a company, do creditors get paid first before preferred shareholders?
Generally speaking, yes. So creditors would be paid before preferred shareholders. Generally speaking, when you're looking, so I don't want to say that this is true in every case, but generally speaking, when you're looking at the people who get paid first and who gets paid last in a corporation, generally debtors will get paid before owners of a corporation. So it'll generally go the debtors before the owners, but generally also it's the preferred shareholders before the common shareholders. Thanks, Ed. That's a good question. So is there any other, or are there any other specific questions about how this whole thing works?
So this Jerry guy, he had to make that decision at age 65. He was going to take $100,000 per year for the next 30 years. But
Yeah.
like, he doesn't know how long he's going to live.
No, he doesn't. So it may have been
It's an
40.
arbitrary number, right?
Yeah,
He just picked 65. It could be done at 55 or 45 or whenever.
exactly. He could have done it at any time in his life.
Yeah, yeah. So the point is not necessarily has to be 65, doesn't have to be $100,000 a year. It can be like he wants to pay himself $200,000 a year.
Could be, definitely.
Okay, okay.
So some of the factors an accountant will take into consideration when figuring out what that number is one, kind of mortality. What age is that person likely to die? Two, they want to try to waste the company away or their shares away if possible. So they don't want to make the amount so small that the person doesn't end up wasting away. For example, if it was $10,000, wouldn't have been worth it in this case, right? They want to look at the needs of that person. They want to look at the capacity of the company to pay out the income. And they want to look at the personal marginal tax rate of the individual. So if it gets above $250,000, then generally the person ends up paying more tax at that point, right? Because they're at the top marginal tax bracket. So the accountant will look at all those different factors in trying to figure out how much the person should be taking per year. And yeah, the current age and mortality, I guess.
Estate freezing and wasting freeze.
Estate freeze, yeah, and wasting freeze.
Wasting freeze. Okay.
So again, maybe, oh, sorry. No, zero. All the preferred shares are issued at the value of the corporation when they were issued. So in this case, the preferred shares were issued at $4 million. So that would have been the value of the shares. Sorry, I'm just responding to Anne. She asked a question. When you said preferred shares are issued at zero value, did you mean zero dividend? No, so zero value at that point. The preferred, or sorry, $4 million value at that point. And then the common shares would be at zero. Does that make sense? Jerry again has preferred shares worth 4 million. Bill and Maya have all the common shares, which are worth zero. And Bill and Maya are the kids, of course. Cool. So no more specific questions right now on how this works. So again, an estate freeze is likely to cost kind of $15,000 and up. So a lot of the time it's going to be used by somebody who really kind of needs this tax planning, somebody with quite a bit of value in the corporation. Because it's fairly complex. It adds a fair bit of complexity to your whole financial situation. So you would want to use it if you're in a situation where it's a real advantage to you. So having said that, I don't know, some of you may be in a situation where an estate freeze makes a lot of sense for you. But say you're not in that situation right now, how do you think, or why do you think it's important for you to be aware of these kind of strategies? I guess number one, do you think it's important? And if you do, why do you think it's important for you to be aware of these strategies? And anybody can just put it into the chat if they've got any ideas.
I'm guessing this is very important for passing down wealth and intergenerational wealth.
Mhm. Yeah. Yeah. So if you're in a situation where you've got a family and you've got a fair bit of wealth, it's going to be very important to put something like this in place, especially if you have a business.
And to add to that, Carl, I think also another important piece to this is that, like how you said, if you're not at that level yet, I mean, eventually a lot of people will get to that level, but it's like, at least now they'll be armed with the right information now so that they don't have to learn from all the, I mean, fortunately, there's bad information out there. You don't have to expose yourself to all that bad info.
Mhm.
Now, once you get to that level, it'll just be easier for you to do, easier for you to understand it now that you have, now that you've planted that seed in your mind, you have this new framework, pretty much.
Yeah, that's a good point. So kind of looking forward, maybe
yeah.
that you're set up correctly now so that in the future you could take advantage of things like this.
And that's how some of the most successful, have like they became successful, is just thinking 5 minutes ahead, thinking in the future. See, sometimes it's not like you need an elaborate plan that's super complex, just kind of being a couple steps ahead of everyone else. So I've been playing a lot of chess lately.
Oh yeah.
That power of thinking ahead.
So how about the rest of you guys? Do you mind typing in kind of a yes or a no, whether you think this is something that's valuable for you to understand at this point?
Anne says it's complex.
Samuel, Timothy, what do you guys think? So Anne, when you say it's complex, are you saying it's overly complex to cover at this point? Or you're just kind of generally saying that it is a complex strategy?
Let's unmute Anne.
Oh, okay, I see. So yeah, Anne said, I need time to digest what I was taught. I came in late, not overly complex, but just need time to understand.
Oh, okay, no problem. Okay. Okay. So the estate, like, you want to summarize again? So wasting freeze is when you get to a certain age and then you convert all your common shares to preferred shares, and then you take a salary or dividends, pay yourself to minimize your tax on the preferred shared side. And then, like, when you die, your children get pay less in well, they don't pay anything because they didn't die, right? So your preferred shares are worth a lot less because you sold them back to the corporation.
Yeah, so I think you have a good understanding.
So that's wasting freeze. And then what was the state freeze again?
Here, I think I have a way to draw it out that might make some sense. So here's the value of your company over time, how it grows.
Yeah.
Okay, so it started at 0. And then let's say it went to $10 million over time.
Mhm.
So what we do is at age 65, this is just a regular estate freeze. We freeze the value and say that's at $4 million. And then your kids, when you die, they only have to pay the tax up to this line. All the rest of this growth went to the kids, not to you.
That's right. So that would be the wasting freeze.
Yeah, no, this is the regular estate freeze.
Okay. See, so that's if you don't convert, right?
That's if you do convert.
Oh, okay. The estate freeze is basically convert to preferred shares. The wasting freeze is pulling salary out or pulling dividends out yearly.
That's right.
Okay, got it.
And just to answer Anne's question, she said, but when you sell preferred shares, there will be capital gains. So no, there won't, because you didn't sell them, you just exchanged them. Oh, sorry, but when you sell, yeah. So if you were to sell all the preferred shares, then it would be a capital gain. This is getting a little complicated, so I'm just answering your question, Anne. But because you're taking it as an income every year, CRA says, oh, yeah, I understand that you're selling your shares and that should be a capital gain. But to us, it looks a lot more like an income than like a sale of shares. So we're going to force you to pay dividends tax on that instead of capital gains tax. So you're right, and generally speaking, when we sell pref shares, that would be a capital gain. But because we're taking it every single year as an income, when we do a wasting freeze, it is considered to be a dividend and not a capital gain.
Okay. Yeah, I think I got it now. So
this is the wasting part right here, Gary.
Yeah.
So every year, I'm going to take an income. So every year, the value goes down. So as a result, I've reduced my tax by the amount of income that I've taken out over those years. So number one, I reduced my tax. I reduced my gain that I'm going to have to pay tax on from 10 million to 4 million. And then number two, I reduced it by the amount of income that I took over retirement.
Okay.
So, Anne, your question was, I am saying as you pull out 100,000, it is treated as a withdrawal of capital or no? So no, it's not treated as a withdrawal of capital because you're taking it as an income every single year. It's deemed to be a dividend by CRA. So I get what you're saying. It's not really a dividend, but it is deemed to be a dividend because of the way we've structured this by CRA. So yeah, there are a lot of complex parts to this that we're glossing over to a certain extent, but yeah, that's essentially the way it works. It is just treated as a dividend rather than capital gain.
So estate freeze is you have a $10 million company. Oh, not $10 million company. You have a $4 million company, and then you convert your common shares to preferred shares. And then you issue like 100 shares to 100 common shares to your children, and they're worth 0. That's estate freeze.
Yeah,
Wasting freeze is so when you die, that $4 million of preferred shares, you have to pay like, I don't know, $1 million in tax. So you want to reduce that. So you do the wasting freeze where you pay yourself dividends every year, 100,000, 200,000 or whatever every year. And then that would be deemed as dividends. And then so when you die, that $4 million preferred shares is worth like, I don't know, $2 million or $1 million or whatever. And
Yeah,
then
so-
you just pay tax on that $1 million.
exactly. So you got the whole concept. Just one thing that I would insert: when you are paying yourself that 100,000 or 200,000 dividend, you're redeeming your pref shares at that
Oh,
time.
redeeming your preference shares. Okay.
Mhm.
Oh,
And that's what reduces the ownership that you've got over time.
okay.
Yeah, again, it's fairly complex, the way the whole thing works. I think you got a good grasp of how it works.
Okay.
I think you're getting a good grasp too, and you're asking the right questions, definitely.
Yeah. So, yeah, like anybody have any questions for Carl? Yeah, if not, definitely, we will be sending out a replay of this webinar in 24 to 48 hours. Feel free to reach out to Carl or me myself if you have any questions. Carl can like give you specific, more tailored recommendations if you contact him and explain your situation.